everybody, and welcome to the Dash Trader Newsroom. Inflation looks like it might have peaked for the moment, but what will this earnings season look like going forward? My name is Michael DeJour. I'm the Director of Educational Services here at Dash Trader and a licensed professional. And I'm joined by my co-host, Jill Molandrino, a global markets reporter at the Nasdaq market site. Jill, how are you?
Doing well. Thanks so much for having me.
Yeah, great. Welcome back. Happy New Year. Happy 2023. Let's jump right in. We had the CPI, the Consumer Price Index, come in down by a point, by 0.1 in December, reflecting a slowdown in inflation. And I have the chart here of the CPI from the Conference Board, and you can see here we did kind of have this kind of double peak in inflation, and we have really dropped off in inflation since then. Now, obviously, this doesn't have all this is like kind of, it breaks it down by transportation, housing, apparel, food and beverage, etc. But certainly there has been a drop in inflation, but the question is, will it continue? What will happen with the price of oil? Because that's the kind of one curveball that can always come in here. How does the US dollar affect the price of inflation? So would love to hear your thoughts on inflation and this CPI number, Joe.
Yeah, it's interesting. I think a big part of it coming down is certainly what we're seeing in housing and in rents, right? Housing's down about 15% on the year. What is surprising to me, though, is food and beverages as low as it is, because I feel like that is something that is glaringly, from an anecdotal perspective, still very expensive. And so that's a bit surprising to me. It doesn't feel like inflation from a consumer perspective, that it has come down. However, you have seen it in housing, you have seen it in rents, you have seen it in transportation. So I think that's really where the bulk of it is coming from. But day to day, it doesn't feel like prices have come in.
Yeah, Jill, just to point out, I actually on this very day saw a meme of a rapper wearing a pack of eggs around his neck. Okay, I saw that one circulating. So it certainly feels that way across the board. Is that if rappers are starting to don packs of eggs around their neck, then certainly food and beverage probably is not as flat as it's reflected by the Consumer Price Index. So I think that pretty much, at least the way we feel, it feels like food and beverage prices have not fallen off quite as much as the CPI is indicating. But I really don't know how these numbers, they change these numbers and the way they gather them, fairly often. I do know the Conference Board has been putting this together for a long time. But again, how that affects the Fed's decision-making process is the key. I just don't see how the Fed can lay off just based off the CPI number. I know we hear all this talk about a pivot, but I mean, the Fed is not just looking to manage the U.S. economy, it's also managing the U.S. currency in relation to our other currencies and to commodities. So, in that regard, I don't feel like the Fed can, completely pivot. It seems like a 0.25 basis point, 25 basis point hike, certainly seems reasonable, but to completely about face, I don't see it as a possibility. But what are your thoughts on this pivot?
I would agree with you as well. Certainly, they don't want to make the mistakes of the 70s and 80s where they pivoted policy too quickly, and then we went into, hyperinflation. I think, a couple of points to what you said before with the egg example. Even if prices do come in a bit, when you think about the packaged goods space, right? How many things have packages subtly been made smaller, or the quantity is smaller than what used to come in? So the consumer is still being forced to spend if they have to have the same volume in the household. And then the Kroger CEO was on CNBC yesterday. And the anchor had asked him a couple great questions, and you and I have discussed this before. The Fed has certain tools to tamper inflation, but it doesn't control supply chains. It doesn't control the replenishing process when it comes to agriculture, whether it's livestock or packaged goods. It doesn't control what happens with wars or with droughts or anything that can impact the supply chain. So I don't, for those reasons, I don't think they are going to make that about face quite as fast as people might be thinking they will.
Yeah.
And that's what's been so curious with this market because you know, we've been told since day one of being in this business is you don't fight the Fed, and that works and the up and the downside, right?
Hmm.
And it seems as if the market just will not accept the fact that the Fed is probably going to go another 25 basis points. It will see cutting at any time, at least in the next quarter or so. And I think they're going to exercise um, a lot of patience and stick to their strategy, which they've been clear. It's not a surprise to anyone. So I think they'll
Yeah.
probably stay the course at least over the next couple quarters.
That might get them.
Well, that brings to mind that do you remember when we went to the first financial crisis back in 2008 and they started the Fed would give dates, okay, and they'd say, okay, we're going to do quantitative easing until September of 2010, and then everybody kind of like automatically factored in that September 2010 that was the date it was going to end. So then Fed kind of moved to quantitative easing infinity, right? Like we're just going to quantitatively ease, and that was kind of not to show their hand. And I kind of think the Fed has to do this with the pivot situation too, right? Like they have to talk tough until they actually decide to pivot. And the Fed has so much as much been saying, Fed Chairman Powell has been pretty much saying, he's like, I got to keep raising because, until I see employment numbers start to drop. And everybody completely discounts this. And it's kind of like a disconnect between the market and what the actual Fed chairman and what a lot of the governors are saying.
Right. Well, it really was an unprecedented time from 2008, 2009 through basically 2022. So you're looking at, 12, 13, 14 years of where we had such an accommodative environment. Now, there's a couple things there. Of course, 2008, 2009, it was an anomaly due to the housing crisis, right? Then we had some debt ceiling issues in 2011, 2012, and then we had the pandemic. I mean, there was a lot that was squeezed in that decade. And, they tried tightening in December 2018. And, look what happened to the market. It was down 20% in December. And I also think the the Fed is a little bit more politicized than it might have been at the beginning of the housing crisis, and I think that's mixed in there as well. I mean, I feel like we've had like a lifetime pat in the
Yeah.
2010s with such events that were anomalies. So I
Yeah.
think, everyone's like, oh, it's not a typical market, it's heightened volatility and so forth. Well, Mike, this is kind of like how markets work. You go up, you go down, you have averages. 6-7% interest rates on a home historically are not that crazy. What we saw over the decade plus a couple of years was not typical.
Yeah. Yeah. It definitely, I think we've kind of adjusted to a reality that was not the reality that was historical. And going back to history, the Fed has a history of over tightening. Like whenever the Fed does start to tighten, historically the Fed over tightens. It doesn't stop tightening when the markets want the Fed to stop tightening. So that is also a historical trend. So let's just jump to the next slide, which is earnings season. Earnings season once again has started. What are the expectations? What do we expect from this earnings season? And in my opinion, I think that really, we have to move forward to earnings season and to see what is the catalyst for stock prices relative to earnings season. I mean, what is going to push prices? Last year, certainly, markets and stocks and corporations probably fared okay, although they were certainly impacted by inflation. But the forward guidance is what I think is going to be key here. And we have all the big banks coming out this just tomorrow, which is probably when this will be released. But I think that's going to be telling because the big banks set the tone for the rest of the market, right? We got JP Morgan, we got Citibank, we got Bank of America, we got Wells Fargo. We got them all going tomorrow. So I think Bank of New York, even Mellon is all. I think they're all tomorrow. Needless to say, what are your thoughts on the big banks' earnings season in general,
Mhm.
and forward guidance?
I think a lot of the news out of the banks happened before earnings. We know Wells Fargo is cutting down on its mortgage business, which is a big chunk of it. We know the regionals have been struggling. I will concede that JP Morgan is probably a decent barometer of what's happening, not only in the domestic economy, but the global economy. So, of course, everyone pays attention to what Jamie Dimon has to say. I think when you look at the asset managers like a Goldman Sachs, when you look at the investment banks, Goldman Sachs, Morgan Stanley, we know deal flow was abysmal, right? We know that there's been cuts. Part of the job cuts are coming
It
from
was
those areas.
3,600 laid off at Goldman Sachs, not even
Yep.
30 minutes warning.
And as you know, the investment banking arm, whether it's through public offerings or through their M&A activity, are such big revenue drivers for these institutions, and the cat's out of the bag there. So I don't think um, any major surprises will come out of that, considering that they have been trickling this down through the market as it has been. Overall, earnings season, of course, forward guidance is going to be the key, as it always is, right? I think listening for things in terms of cost of capital, how they're servicing their debt. I think you have to pay attention to companies that are considered growth companies where a lot of their expansion in R&D was funded through this cheap capital. So you have to see, what that looks like. I think sentiment was so overly negative coming into the year, and our market technician and I just discussed this on our show a half hour ago, that the risk is to the upside, right? We're seeing analysts make adjustments to their estimates. What we've seen in the market just in the first few trading days, of course, we have 15 minutes, one more session to go. We're seeing growth areas like the semis really provide some leadership here. And Mike, as you know, certain technical patterns there, whether you're looking at the Nasdaq 100, you look at the SMH or the SOX,
Yeah.
you're starting to see potentially the beginning of a little bit longer term trends.
Yeah.
And typically, these are the areas that lead in a recovery. The market is a discounting mechanism, so perhaps it's thinking 6 to 9 months out. And what's everyone saying? Second half of 2023 is going to be better. Again, a few trading days is not a market make, but I'm surprised at least by
Yeah.
how the market's held in there.
So yeah, they usually say that the microcosm macrocosm analogy is that as the year starts, so goes the year, right? That's the microcosm macrocosm. So the first, basic 2 weeks of the of 2023 were fairly good. I mean, we were deeply oversold, however. We were very, very deeply oversold. And if you look at the charts, which we're going to look at later in the monthly analysis, the monthly charts and the weekly charts were all at key technical levels. They were all at key trend lines. They were all at major moving averages, and we were oversold. So these companies were showing that they were being sold at a discount, right? So they the opportunity to snap them up. We saw a big rally in the meme stocks. All the meme stocks were completely beaten up, and they snapped back a lot, like Bed Bath and Beyond and the AMCs of the world, right? These stocks that have gotten slaughtered. But so this is just really technical trading from stocks that had been really beaten down.
Right. And to your point, you use the right word, trading, right? I could tell you anecdotally, and again, I'm kind of more the fundamental side of this Mike Jill show.
Yeah.
Myself personally, again, working for an exchange, we can't buy and
Go
sell
into
stocks like a
individual
day
stocks.
trader,
Yeah,
right?
yeah.
But on Tuesday, first trading day of the year, I went and picked up a couple of shares in a REIT ETF that pays a great dividend. So I'm looking for, I can take some of the pullback because of the dividend that's paying. I also, in another account, I picked out an ETF that has a great track record that focuses exclusively on blue chip growth companies with solid balance sheets that pay back shareholders in terms of buybacks and dividends. So I'm not going for anything sexy, not going for a specific sector, but looking for these companies that are value and growth and are consistent dividend payers, not yield, because yield is a different thing. It has a high yield for a reason, but dividend growers and consistent dividend payers.
And when you look at last year, even though 2022 was an abysmal year for the markets overall, 2022 wasn't that bad for the Dow Jones, and we're going to look at that in the chart analysis section. For value stocks, the Dow really was only down. I mean, it was down less than 10%. I mean, it was not a terrible year for the Dow Jones. It was very bad for the Nasdaq and all the tech companies that had led up with that inflated growth from the pandemic. The pandemic really super fueled their growth. And of course, that certainly explained the stronger than average pullback. All right, so let's jump on to the news. So who are the most probable winners and losers this earnings season? Remember that this is the end of year results for 2022. I mean, the big names in my mind, and I just put them on the slide there, were Apple. The drop in Tesla was kind of a historic drop, like the glamour and glitz of Tesla kind of wore off. And then certainly, there was Disney that had to change its CEO, and kind of went into a different direction. But from a sector perspective, is it value? Is 2023 going to be the year of value, old economy, old industry? Or like you said, dividend payers. Certainly fixed income is looking pretty good.
Look, you know what, Mike? Clearly nobody wants to take losses, but myself and people that I have from the private equity VC space on the show all the time, M&A bankers that are on the show all the time, really do agree that these valuation resets needed to happen, particularly at the private level. And in a way, I think this is good for investors because when we're focusing on, oh, look at all the unicorns we have, look at the valuation. Oh, I became a unicorn in 21 months. Who cares, right?
Yeah.
You can't value a company on projected 5-year production for something that's not even in production yet, right? So
Yep.
path to profitability, solid management teams, decent balance sheet, cash on it. I think this is a good thing because you know what happens when these come to market at these ridiculous valuations? Guess who's the one that buys it at those lofty valuations? The public investor. And you don't want them to shy away from the market. It's good to be invested in the American stock markets, right?
Yep.
So I think it was a healthy thing. And I think, everyone has short-term memory, and I'm sure we'll have this conversation 10, 15 years about something else. But um, I think investors are going to be highly discernible, not trading, investing, of the companies that they're looking to put their capital to work. They're going to be more discerning about their balance sheets, the businesses that they're in. Of course, sustainability and governance are big issues now too, which lends to some of your more mature, older companies. But again, if what we're trying to teach everyone is if you want to think long term, look for these companies that are paying dividends so that you are being paid to hold these names should we go through volatility, and we will.
Yeah, and so I have to say, and I have to bring this one up. I mean, you and I kind of got into this game around the same time in the late '90s, and every time I always hear this time is different. It's just never different. Like Warren Buffett's kind of look for value, look for a strong management team, look for a company that has a good outlook going forward, and I mean all these tried and true investing disciplines.
Right.
And I know personally this time around on this pullback, I'm looking to, at the age that I'm at, I'm looking to take some long-term positions and
Exactly.
hopefully invest in good companies for the
Right.
long term. And I
Well, you know
think
what?
that hopefully the retail investors actually follow the same kind of approach because
I think
usually
so
this
too.
time is not different.
I think I will say where it is different. So I just said before, in 10, 15 years, we'll have a conversation about something else. Um, Irrational exuberance and greed are part of the human psyche. So
Yes.
is it different in terms of 28, 2009? Yes, it's different because we don't have the systemic issues that we had with banks blowing up and now they're more regulated and their balance sheets look healthier and we don't have as many exotic products floating around to the public. So it's different in that respect. So there's always same thing, with the dot-com bubble as well. And we're
Yeah.
seeing that again now where we're looking at valuations and we're looking at how companies are um truly managing themselves and showing that they, not only are they innovative, but they also have a good business behind them.
Yeah. Yeah.
So
Absolutely. It's a very, very good points. I want to wish you nothing but the best this
thank you.
weekend. We're going to jump to the charts and analyze some of these the stocks that we just talked about. But thank you so much for joining us, Jill. And we have a
Awesome.
number one best trader competition coming up in February,
Yep.
sponsored by Cobra Trading. And I'll see you soon. See you in the
All
next
right.
episode.
Sounds good. Thank you.
Bye bye. Have a great weekend. All right, let me jump to the charts here. All right, so let me just bring up my Dash Trader. I got a couple of charts all lined up here for you on my Dash software. So here is number one, the first chart that I'd like to take a look at. Here, what I'm noticing here, this is on the SPY. We're noticing that we have a top, a double top, triple top, almost a head and shoulder on the CCI. Now, the market's been up for 1, 2, 3, 4, 5 days. And now we have this kind of head and shoulders type pattern. and a divergence on the CCI, that usually indicates that we are deeply, deeply overbought and might be ripe for a reversal of some kind. How big, I don't know, but certainly you see the same kind of a situation. It's not a head and shoulders, but you see the same kind of a situation on the QQQ. That represents the Nasdaq. And I'm just going to bring up Apple because we mentioned Apple. Apple again has got that double top divergence. It's up 5 days off its lows, kind of coming into that support level, which is resistance. So that's Apple. Then we got Tesla, TSLA. Tesla really not up too much, really not overbought like the rest of Tesla, showing some relative weakness. We have, let's take a look at JPM. So this one's really interesting. This would indicate that JP Morgan, the earnings have not come out yet. They're going to come out tomorrow, but this would indicate that we're going to sell off on earnings tomorrow because the stock is up so much. It's done what we call as an earnings run. So it's got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 days up, running into resistance after 15 days up. That's a real beautiful earnings reversal setup. And by the time this comes out, you're probably not going to have the opportunity to take it because it comes out, their earnings come out tomorrow. But you see the same thing on Citibank. And of course, Bank of America, BOA, BAC. Bank of America, not so much, but certainly similar. It's kind of had a nice little earnings run. So you could see on all the banks, WFC, you see a little bit of a nice run up into their earnings and possibly setting up for an earnings reversal. There's Amazon making a run already. So, that really doesn't bode well. When a stock runs up into earnings, usually it reverses on the actual report when it makes the run before the report. So that would probably indicate we got some selling. So we got the CCI indicates selling on the QQQ. We got the SPY indicating some selling with a head and shoulders on the CCI. And you got, all those big runs up on all the big banks. Let's see Goldman Sachs. Goldman Sachs running up as well. Their earnings is not tomorrow, but certainly it's already been running. We have like all those meme stocks have done a nice run. We got GME. Let's see what GameStop. Yeah, GameStop up from 16 to 20, crazy. BBY, but this is Best Buy, I believe. Best Buy, yeah, Best Buy. Wow, look at that. Yeah, there's Best Buy. Bed Bath and Beyond. That's just crazy. I mean, absolute insanity in some of these stocks that were really deeply oversold. But needless to say, these are very, very volatile. I mean, very rare do you see it from the CCI reading of 100 to 200. Now, one thing I want to say is that look at the old man gold breaking out big time. I mean, that is a very telling sign that gold is just breaking out big time. Let me just load up a different chart setting. This is the MACD with the CCI. Let's look at it on a weekly chart. I'm going to go data config, go back a little bit further. I'm going to go back to maybe there. Look at the run in gold from 150. Gold straight shot up to 176 from 150, just exploding to the upside. To me, I don't think gold's going to stop until it hits 185. Although we are getting some oversold readings on the CCI already. GBTC, which is Bitcoin, making a big run up in recent days. So we're really getting a relief rally across the board on all of these is MSFT. I'm just going to go into the daily on this. This is Microsoft. Microsoft made a huge run up. Certainly Microsoft, a very solid company. They have what looks almost like a double bottom with a higher low on Microsoft on an all-time low. So, I mean, Microsoft really at a key level here when you go onto some of the longer time frame charts and you go to the QQQ, very similar. I mean, QQQ does not necessarily need to indicate that it's done going down, but certainly Microsoft showing more strength than the QQQ. The DIA, like I mentioned, the DIA really not near its lows at all. If there's a place to be, it's the blue chips, it's the DIA. The Dow Jones Industrial Average really doing very well. Low, lower low, and then a possible higher low with a shelf. This would be a cup and handle kind of formation on the DIA. So certainly the strength is in the Dow. All right. Well, on that note, I'm going to jump right back to the charts and wrap things up. We just wrapped up our market analysis. So let's stay up to date on all things DAS on our monthly newsletter and emails. Just simply fill out the form at dastrader.com. Subscribe to our YouTube channel, Dash Trader TV, and certainly all of our social media channels, the LinkedIn, Twitter, Facebook, and Instagram. And don't forget that we have the #1 best trader competition sponsored by Cobra Trading and Benzinga starting just at the end of the month. I believe it's starting on January 29th or January 30th. So don't miss out. That's going to be a very exciting, larger than usual competition as it's sponsored by Cobra Trading, one of our premier Dash Trader brokers, and Benzinga, a very well-known educational firm and news firm. So join us in the #1 best trader competition. Everybody have a wonderful, wonderful weekend. Trade well, and look forward to seeing you next time.